My name is Anthony Kim. I'm a partner at Kim and Rosado, a tax law firm based in Los Gatos, California, and Walnut Creek, California. We also have offices in New York as well. And here's my partner, Nick Rosado. We're both former IRS attorneys. We left the IRS, Nick, about 3 years ago, me about 11 months ago, and we're practicing on the private side now. Now, with that said, this segment is going to talk about what Nick did while he was with the IRS, which was he was on the cannabis litigation cadre. So Nick, can you talk to the viewers about what exactly you did on cannabis issues with the IRS?
Sure. Thanks, Tony. The cannabis industry is in a strange space. So many of these companies are operating legally under state law, but cannabis continues to be a Schedule I drug that's outlawed under federal law. So while it's legal for state purposes, it's illegal for federal purposes. And there's a provision in the Internal Revenue Code, Section 280 Cap E, which says if you're trafficking in a Schedule I substance, such as cannabis, that you don't get any ordinary and necessary business expenses. So these are things that businesses would normally take, such as rent, wages, transportation costs, especially for the cannabis industry, security costs, things like that may not be deducted as business expenses. And as this developed, as the legal industry started to develop, the IRS began to look into this, and they found that a lot of companies were taking business deductions despite the prohibitions under 280 Cap E. Therefore, the IRS started to heavily audit this, and there was a lot of litigation around this issue. To deal with it, the IRS developed what was called the marijuana cadre, which was a group of attorneys that were tasked with both advising the client, with the client in this case was they were IRS revenue agents and revenue officers who were tasked with enforcement in this industry, audits and collection matters. So we would advise those agents of the IRS agents, and we were also tasked with litigating all of these cases in the United States Tax Court. So as this was a heavily disputed issue, there was certainly a lot of litigation that went on that we were tasked with.
Can you explain what's the difference between a business expense that a cannabis company took or claimed on a return that would be disallowed under 280 Cap E as a black and white matter versus cost of goods sold, and whether cost of goods sold is covered under 280 Cap E and therefore not deductible as well? So
in the law, it's hard to speak of black and white, Tony, but as best I can. So let's take, for example, rent. So if you have a store that sells marijuana, you're probably paying a lot of rent if you're in certain city centers, but you're paying rent to sell your products to customers. So that's generally an ordinary and necessary business expense for any business. So any business would generally be able to take any rent payments as deductions against income. Therefore, they wouldn't pay tax on that amount. They would reduce their income by those rent expenses and only pay tax on the net profit that remained after the rent expenses and any other ordinary and necessary business expenses. So 280 Cap E says, if you're trying to take this rent that you're paying as a business deduction, you can't. You're disallowed. That's disallowed. So you cannot take it as a business deduction. Cost of goods sold is different. So 280 Cap E doesn't touch cost of goods sold. So cost of goods sold is the cost of acquiring goods, the cost of the goods that you're acquiring, related costs of acquisition. But there are different types of cost of goods sold depending on the type of business you are. So if you're a retailer or a distributor, cost of goods sold is like what I just stated. It's acquisition costs, the cost of acquiring your goods, not the cost of selling, the cost of acquiring. But if you're a producer, so if you're actually growing the crop and then marketing and selling after that, cost of goods sold, it's different because it's the cost of production. And so that may actually include at least, a good portion of your rent, wages, other types of expenses that maybe for a distributor would be disallowed under 280 Cap E. These are included in cost of goods sold for a producer because they are the indirect costs of producing the product. So that's where things get a little gray, because costs of goods sold are not disallowed by 280 Cap E. They have to be allowed. It's a constitutional issue. So the courts have found that businesses cannot be taxed on gross receipts, only on gross income at most. So cost of goods sold has to be allowed as in to offset gross receipts to bring it to gross income. So to the extent something can be included in cost of goods sold, it's not going to run afoul of 280 Cap E. But what cost of goods sold is still a disputed issue. We have the Internal Revenue Code, which defines it. We have some Treasury regulations, which is the IRS's interpretation of the Internal Revenue Code. But again, this is a constitutional issue. So what is cost of goods sold is certainly a very important issue.
Right. So for cannabis companies out there, there are certainly some issues that are right in the sweet spot of Code Section 280 Cap E. But as you noted with cost of goods sold, there are other issues that affect cannabis companies that are in the gray area that require tax counsel, whether it's CPAs or tax attorneys like you. So Nick, thank you for your comments. I hope this is helpful for those of our viewers who are in the cannabis space. Thanks a lot, Nick.